Sunlight hits the ticker tape. Numbers flicker, then vanish. People panic. Phones buzz like swarms of insects in a summer heat. Headlines scream, "Markets crash." But you notice something odd. The chaos on Twitter doesn't match the calm in the vaults of major banks. Here's the truth. Markets aren't scared of what you see. They're scared of what you don't. Not the obvious, not the headlines. The tiny, almost invisible shifts that ripple through commodities, debt, and oil flows while everyone's eyes are glued to the screen. Look around. Gold just blinked down 0.7%. Silver barely moved. Investors are yelling about inflation and interest rates, yet some central banks are quietly stacking reserves, the kind of moves you only hear about weeks later. This isn't about fear, it's about perception. You think the market is trembling because oil spiked or because rates might rise? Maybe, but the real tremor? It's underneath. Hidden positions, global debt dynamics, supply chain squeezes no one talks about until the dominoes start to fall. So before you reach for the panic button, take a breath, listen, watch. The market doesn't react to panic, it reacts to what the crowd hasn't noticed yet. And right now, that's exactly what's happening. The screen shows it first. Gold slipped 0.7% yesterday, silver edged down 0.4%. Oil futures climbed 1.8%, settling near $84 a barrel. The S&P 500 lost 1.2%, the Nasdaq down 1.5%, while the Dow held steady at minus 0.3%. Volume in metals trading spiked, though not dramatically, roughly 12% above the 30-day average. On the calendar, this was the second week of March. Timing matters. U.S. Treasury released updated debt projections showing $1.3 trillion in annual interest payments, up from $1.25 trillion last quarter. Meanwhile, the Federal Reserve added $10 billion in balance sheet purchases, absorbing Treasury notes to support liquidity. Comparing to last week, gold had been flat, silver slightly up. Oil had declined by nearly 2% before rebounding midweek. The relative moves are subtle, but notable. The metals market hasn't crashed, it's rotated. Paper losses appear larger than actual market impact because positions are concentrated in a few volatile instruments. Market participants reacted quickly to geopolitical news. The Pentagon requested $200 billion in unbudgeted spending to fund operations overseas. Equities in energy and defense sectors moved first, with defense contractors gaining 0.9% while broader markets lagged. In sum, prices shifted moderately, liquidity remained adequate, volatility ticked up but within recent ranges. No dramatic closures, no margin calls reported. Gold and silver remain above their year-to-date lows. Oil rose, equities mixed. Treasury yields increased marginally, CPI and PCE data pending this week. The observable, measurable facts. Markets rotated, some assets up, others down, overall risk metrics stable. When gold drops 0.7% and silver 0.4%, it doesn't just change a number on a screen, it nudges behavior. Traders in physical metals may pause their orders. ETFs see slight flows in or out. Banks adjusting collateral requirements notice a subtle shift in liquidity. Small, almost invisible changes ripple outward. Oil rising 1.8% touches more than energy indexes. Refiners reprice contracts, shipping costs adjust, manufacturers recalc budgets. Those adjustments are first-order effects, immediate, tangible, measurable. Then second-order effects unfold. Higher oil prices increase operational costs for industries from airlines to plastics. Some corporations delay capital spending. That in turn affects employment in energy and transportation sectors, slows supply chains, and nudges inflation metrics. The Fed may notice these trends in upcoming reports, which could influence interest rate deliberations. Defense spending requests, $200 billion unbudgeted, push expectations for government borrowing higher. Treasury yields rise, long-duration debt slightly less attractive. Pension funds recalibrate portfolios. The movement of money isn't dramatic yet, but the signals reach institutional investors first. Individual investors often perceive these shifts only after the markets react. Precious metals react differently. Gold and silver are caught between two currents. the subtle fear of higher rates, and the historical tendency to gain appeal during uncertainty. Real demand, especially for silver in industrial and strategic uses, creates an undercurrent stabilizing prices. Even in a modest pullback, these metals maintain a baseline of value. In effect, what looks like minor movement is actually the starting point of interconnected adjustments. Traders, banks, manufacturers, governments, and consumers are all moving in a chain. First reactions, second reactions, ripple effects. Understanding these layers helps clarify why a 0.7% drop in gold isn't panic. It's a small signal in a broader web of economic interactions. In short, these numbers matter because they are not isolated. They trigger reactions, some immediate, some delayed, across multiple markets and sectors. Watching these chains unfold is how professional analysts perceive risk and opportunity beyond the headline. Looking back, there are a few moments that echo today's environment. In 2008, oil spiked, equities plunged, and gold initially dipped before climbing steadily. In 2011, post-financial crisis liquidity drove metals higher, even as global debt concerns lingered. The early 1970s saw inflation surge alongside geopolitical shocks, and precious metals responded over years rather than days. The pattern is familiar. Uncertainty drives rotations across assets. Metals act as both hedge and speculative play. Markets pause before resuming trends. Traders then and now often misread short-term volatility as the end of a bull run. But the differences matter. Today, interest rates are lower than in 2008 and far below the early 1970s highs. Central banks, particularly the Federal Reserve, have tools, balance sheet purchases, emergency liquidity programs that were more constrained in past crises. Industrial demand for silver is higher today than during past recessions, creating a baseline of consumption that didn't exist in the same way in 2008 or 2011. Debt dynamics also differ. The U.S. government's borrowing needs combined with global reserve positioning means central banks and institutional investors are influencing the metals market at levels that didn't align perfectly in historical cases. Technology and market transparency accelerate reactions now. Information flows instantly, positioning adjusts in hours instead of days or weeks. So while it's tempting to compare today to past crises, history only provides context, not prediction. We can see how markets responded under similar pressures, which helps temper emotional reactions. Yet the differences, rates, industrial demand, debt structures, speed of information, mean outcomes may not replicate the past exactly. Historical context acts as a lens to filter panic and highlight structural patterns, not as a crystal ball. In essence, today's metals markets have echoes of history, but the environment is unique. Knowing the similarities and contrasts equips investors to interpret movements with perspective, separating observable dynamics from hype. Bull case, upside continuation. If central banks maintain liquidity and industrial demand for silver remains robust, then gold and silver could resume their upward trajectory. Supply constraints in strategic metals, combined with modest geopolitical shocks, may encourage both governments and institutions to stack reserves. If real interest rates remain negative, then precious metals retain their appeal versus cash and bonds. In this scenario, volatility may spike temporarily, but each dip becomes an opportunity for accumulation. ETFs and physical markets see incremental inflows. Investors who hold through the pullback may see strong appreciation over the next 12 to 18 months. Base case, stabilization and gradual movement. If Treasury yields rise moderately and the Fed enacts limited rate adjustments, then metals prices may oscillate within a narrow band. Industrial demand continues, but geopolitical tensions stabilize. The S&P 500 and energy markets fluctuate, but remain generally within trend. In this path, gold may fluctuate around recent highs, silver may trade slightly below current levels, and pullbacks are absorbed without structural disruption. Liquidity remains ample, and no major margin calls occur. Investors see range-bound behavior, small gains, small losses, but overall retention of value. This is the most probable scenario if markets digest current geopolitical and economic signals without triggering a broader shock. Bear case, adverse trend. If inflation spikes unexpectedly, causing the Fed to aggressively tighten, or if a sudden geopolitical escalation disrupts supply chains significantly, then metals could experience sharper short-term declines. In this scenario, industrial demand may slow, market liquidity could tighten, and speculative positions may unwind quickly. Gold and silver would still have intrinsic demand, but prices could test the lower bounds seen earlier this year. Importantly, these conditions are conditional. A combination of high rates, reduced industrial demand, and sudden liquidity stress is required for a decisive downtrend. Governments and central banks may intervene, but the timeline and magnitude of response are uncertain. Across all scenarios, the key is conditionality. If X happens, then Y follows. If not, markets may drift differently. These probabilities are not certainties. They are frameworks to understand how various drivers interact. Real-time observation of liquidity, industrial usage, geopolitical signals, and central bank actions informs which scenario is unfolding. Thinking in probabilities allows disciplined response without emotional overreaction, keeping the focus on measurable indicators rather than headlines. When I say watch the indicators, I mean the ones that actually move markets, not the Twitter chatter. Start with the US dollar index, DXY. A stronger dollar usually puts downward pressure on gold and silver, while a weaker dollar tends to boost them. Watch for sudden spikes or drops. Even small movements can trigger short-term volatility in metals. Next, Treasury yields. Short-term and long-term yields signal how the market prices borrowing costs and inflation expectations. A rising 10-year yield can weigh on gold, but if yields outpace inflation, real rates remain negative, which historically supports precious metals. Keep an eye on curve shifts too. Flattening or inversion can hint at broader economic stress. Inflation metrics matter. CPI, PCE, and other core inflation data provide context for real interest rates. If inflation outpaces yields, the real rate goes negative, making gold and silver attractive as stores of value. Conversely, low inflation in a rising rate environment can create pressure on metals. Then look at volume and liquidity in metals markets. ETFs, futures, and physical market flows show where money is moving. Rising volumes and small dips suggest accumulation, while large outflows could signal short-term risk. Finally, open interest and positioning. Futures contracts, margin exposure, and hedging activity reveal what institutional investors are doing. These are often the early signals of where the next move could start. Together, these indicators form a map of the underlying forces. Watching them helps you see beyond headlines. You don't need to predict every move. You need to understand what actually drives the market, who moves first, and which signals matter most. That's how professional analysts stay ahead without panicking over daily noise. Take a breath. Markets move. Gold and silver fluctuate. Oil spikes. Equities wobble. That's normal. It doesn't signal the end of a trend. It signals adjustment. Focus on the fundamentals. Industrial demand, central bank reserves, real interest rates. They don't vanish overnight. Watch them, not the noise. Keep perspective. Short-term swings are not your enemy. Patience is. Remember, this isn't investment advice. It's simply how I'm reading the market right now. Plan around risk, allocate with intention, and don't let headlines dictate decisions. The market rewards discipline more than panic. Look forward, not backward. Understand the chain reactions, track the indicators, and keep your eyes on the structural patterns. Over time, staying measured is what preserves capital and opens opportunity.